Welcome to this week's edition of Flashback Friday, your opportunity to get some good review by listening to episodes from the past that Jason has handpicked to help you today in the present and propel you into the future. Enjoy.
Welcome to Creating Wealth with Jason Hartman. During this program, Jason is going to tell you some really exciting things that you probably haven't thought of before and a new slant on investing. Fresh new approaches to America's best investment that will enable you to create more wealth and happiness than you ever thought possible. Jason is a genuine, self-made multimillionaire who not only talks the talk, but walks the walk. He's been a successful investor for 20 years and currently owns properties in 11 states and 17 cities. This program will help you follow in Jason's footsteps on the road to financial freedom. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Hey, welcome to the Creating Wealth Show. This is your host, Jason Hartman. This is episode number 287. A super short intro today. I just want to get to our guest. We have a lot to talk about on future shows, and we'll be back with that in the next episode. But before we go to our guest today, just quickly, we only have a very, very few more seats for our Meet the Masters event in January. I'm guessing right now, but there's probably like 6 or 8 more seats left in that room. We were not able to get a bigger room. This one will max out at about 80 people. So please register for the Meet the Masters event January 18th through the 20th, Hyatt Regency Irvine, and you can do that at jasonhartman.com. Get the last few seats there because we're about to close it out and call that event completely sold out. Okay, let's go to our guest in just a moment. Hey, it's my pleasure to welcome Tony from Cleveland calling in, and he's got a very good question about inflation and more specifically target inflation. Tony, how are you?
Good. How are you doing, Jason?
Good. It's great to talk with you, and thanks for calling into the show. So tell me what is on your mind.
Well, my question revolves around inflation, and I hear you talk about a lot on your show, and I know you talk about investing in multi-unit properties and single-family real estate as well, and you call them packaged commodities, and this helps keep pace with inflation and the expected inflation that you see coming.
Right.
And, my concern is, and I have 2 duplexes in which I hope, I'm doing the right thing with my investments. I love my duplexes. They give me cash flow, and long-term, I really hope that they do well for me. But what I'm concerned about, I hear you talk about it a lot, is you talk about inflation, and I'm concerned more about targeted inflation. And what I mean by that is the Fed, as you know, they take inflation and they measure it in a different kind of way. They use kind of an accordion feature in which they take items in and out of the inflation pool.
And let's just explain that a little bit for the listeners. That's the basket of goods, so to speak, that the CPI or the Consumer Price Index uses. And of course, like you said, they take things in and out. That's called substitution. And they also weight things differently. That's called weighting. And so they weight, they substitute, and then they apply hedonics to it, which we've talked about on prior shows too. So, but yeah, go ahead with the target inflation question.
Right. And basically what I'm getting at is, historically, a lot of our people's income usually gets, sliced up in the pie of their budget. In historical terms, a large portion of that pie has been always used for rent and, your any kind of debt instrument, like a mortgage or,
right. Your housing
or
cost,
even,
in other words.
even a car, for that example, for an example. But, in historically, what we've seen, I think, is a large portion of the consumer's budget being appropriated towards those things. But as I'm starting to wonder if we're starting to see maybe something a little different as far as maybe, are the consumers going to be constrained where you see certain items becoming hyper-inflated and you're going to see a bigger inflation rate on things like utilities, electric, gas, water, sewer. And I talk about those in historical terms. Those have always been a really small portion of the, Americans' budget. But, my concern is here in Cleveland, for example, the sewer rates are astronomical. And they've laid out, like, the rates are going to go up exponentially over the next 10 years. And that's really going to put a ceiling on, the amount of rent that I'm thinking you might be able to get long term, those kind of increases. Is that going to kind of, I guess...
Is it going to derail your investment?
Yield? Right. Is it going to curb the yield of your rent going up?
Let's talk about a couple things here. First of all, so when you talk about target inflation, who causes target inflation? Are you saying that the Fed can actually control which things inflate more than others? I mean, I first want to kind of smoke that part of the question out, and then I want to talk about utilities or certain things rising and other things falling or staying even.
I'm not seeing so much as, target for, say, the Fed goes and says, we want this type of commodity to raise in value. I'm not talking about that. I'm talking about more because the scarcity of resources, specifically with the global economy. You got China, India becoming big players, especially for energy. And are those demands going to really inflate? And especially as more people come out of poverty across the world, you're going to have a huge demand on natural gas, oil. You're starting to see that. And is this going to push constraint on the amount of rent you're going to be able to charge and the value of houses, for that matter?
It's a great question. Now, let me address it. I don't know what your point was there, but let me just kind of make it a little more succinct, if I may, okay? So here's the thing. Personally, I think energy costs will continue to rise, and as they rise, that will actually increase the cost of those, what I call packaged commodities or houses, because energy cost is in every single product and service we buy. Energy is everywhere. It's omnipresent. And so if the cost of energy goes up, the cost to build a house goes up. Now, granted, your thinking is very interesting, because what you're saying is, well, gee, if the cost of energy goes up a lot, will that curb the ability for me to charge more rent in the future for my properties? And
not just that, the price of houses or commercial buildings are they going to be able to go up at the same rate and increase if you can't get a loan, or the cost of that loan is going to be such that, it's going to put constraint on a budget, any kind of budget, like a household, especially more to the single family house perspective.
Yeah, let's not go into the loan and financing yet, because that's sort of a different discussion. Let me just address the energy part, okay? I say, and again, this is just my feel about it and my prediction. I could be wrong, okay? But I say, and I'm pretty sure I'm going to be right about this one, that the higher the cost of energy goes, the higher the cost of housing will go, because it costs more to build a house, to build an apartment building, and it's going to cost, and if it costs more to build it and own it, it's also going to cost more to rent it. Here's what declines. What declines as these things go up, and food will cost more. Energy will make everything cost more. If energy is more expensive, everything else is pretty much more expensive too. But here's the thing. The thing that will suffer, where does the money come from? If people have to pay more for food, if they've got to pay more for utilities, if they've got to pay more for all of the goods and services that are derived from energy, and energy is a component of all those costs, then here's where the money comes from. It comes out of the standard of living. The standard of living is what suffers and declines. And I've said it many times, look at it like two ladders, okay? And this is the best way I can think of to visualize it. There's probably a better way. But if you look at the tenants you have two duplexes now. And your tenants that live in those duplexes, they have been throughout their adult lives, and well, their childhood too, but let's just take their adult lives. They have been at different levels of the socioeconomic ladder. Sometimes they've had a great year and they've been doing really well and they've got more money to spend and they live in a nicer, better, bigger place in a better location. Other years, things aren't going so well. They've got less money to spend. They live in a smaller place. They live in an inferior neighborhood, and they live in an attached house rather than a detached house. So this varies throughout one's life. But where the cost will come from is it will come out of the standard of living. So if your tenant lived once in a 3,000 square foot house in a nice neighborhood, they may in the future, as these costs rise, live in a 1,200 square foot house in a lesser neighborhood. That's where the cost comes from. And the reason I know this is because if you look back in I lived my childhood, I grew up in Los Angeles. And in my adult life, I pretty much lived in Orange County, which is about 40 miles south of LA. And there's an area there, Newport Beach, which I've lived in Newport Beach, Irvine, etc. And in Newport Beach, there's this really nice upper class neighborhood. It's called Harborview Homes. And Harborview Homes, those homes I think were built in the early 70s. And I think, and I could be wrong on this, but I remember I did study it before and I really thought a lot about it many years ago. Okay, so don't quote me on the exact numbers, but I'm just giving you the concept. But I think when those homes were built in the early 70s, you could buy one for like $42,000 to $62,000, something around there, okay? And here's the deal. They started, I think the smallest home in there is like maybe 1,600 square feet, and then there are larger ones. And it's a really nice neighborhood. It's got a school down the middle. Nowadays, it's like the Keep Up with the Jones yuppie neighborhood. Everybody's driving a Range Rover and trying to outdo each other, and everybody went to USC and UCLA and all this stuff, right? But here's the thing. The funny thing is that you see all of these studies, they quote, okay, Americans are living better than they ever have because the typical home built after World War II was 900 to 1,200 square feet or whatever it was, right? When all the people came back and the economy started to boom after World War II. And now the typical home is much larger than that. It's maybe, right. I don't even remember the number. It's maybe 2,200 square feet. And you think, by looking at that, not knowing any better, and this is why you can't just look at a book or a website. You have to think about these things and be experienced in the market. But what they didn't tell you in that is how much smaller the average yard got and how much denser the people started living. They started living like rats stacked on top of each other in high-density housing developments. Yes, the unit they lived in might have gotten larger, but the yard and the piece of land that they had with it and the location of that property got smaller and lesser and inferior. So it's not just about the square footage of the unit. It's the whole picture. If you lived on a 10,000 square foot or 12,000 square foot lot in Harborview Homes in this area of Newport Beach versus living in, I'll just take, for example, another area of Orange County in Garden Grove, you might live in a larger home, but just doesn't make sense when you look at these studies.
And I see what you're saying,
yeah.
and you can actually look at. One thing I find fascinating is around here in Cleveland, there's old homes here. You got homes from the early 1900s, and one thing that just kind of shows how we've, I guess, grown as a society or how we have so much more disposable income is look at the closet space. You go into a home in, a 1900 home, a closet is, it's one door. Then all of a sudden in the 70s you saw the two-door closets. Now you got walk-in closets. So just people are having more and more disposable income and buying more and more things. And I guess to my point is, for example, utility bills in my area, we've just become deregulated here, and you're starting to see a lot of electric and gas companies. You can pick your own service, and you pay. And what they've kind of done is they've upped the fixed rate. Usually, in the past, the fixed rate has always been really low, but they've upped the fixed rate to say a minimum of $25 for gas up here in Northeast Ohio. In the summertime, it's usually pretty cheap, and your gas bills would be pretty low. But now they've jacked the fixed costs up to $25, right? So now, and they've lowered the cost per unit, per MCF or per unit of utility. But I have a feeling over time, those things are going to start to go up. And that's going to put pressure on how much more rent I'm going to be able to raise, because typically in the past, you'd figure 3% inflation, I can boost my rent depending on the area, 4 to 5%. But my fear is these utility companies are going to say, you know what, we're going to slice them out, and we're going to start increasing our rates, and it's going to really damper. It's funny. My buddy, he works for the sewer district, and his famous quote is, you know what, someday you're going to have to choose over cable are your sewer bill. That's how it's going to be in the future. And in a way, I kind of laugh, and I'm like, you know what? He's probably right. They're just going to jack the rates up so high. And one more thing. You talk about the taxes, and obviously that's a whole different discussion, how we're so much in debt. But what municipalities are starting to do is they, because they own these sewer districts or these regional or water districts, they're passing on the tax base that they're missing out into these utilities to try to extort more money out of people, because they can't get it through the tax base.
Right. Remember, you're listening to Flashback Friday. Our new episodes are published every Monday and Wednesday. So I say one day you're going to have to choose not just between, like your friend says, your cable and your sewer bill, but you're going to have to choose between a bigger house and a smaller house, a newer house and an older house, a better neighborhood and an inferior neighborhood, and that's the choice everybody has to make today. But the standard, what is going to happen in America, and it's already happening, I mean, it's been happening for years, is the standard of living is going to decline. It has to. I mean, folks, the only thing that can really rescue us from this, and here's where it's the wild card, and it's what I don't know, and I hope I'm totally wrong about it. The thing that could save us all is technology. I have a friend who's a young guy, okay, he's like 23, and he just moved here to Phoenix from Dallas. He's actually my neighbor, and he works for this energy company, and they think they have solved the energy problem. And they've got this little black box, and they say, and I don't know how it works, I even had them talk to one of my energy friends who was in the energy business, and he couldn't figure it out either. They say they've got this little black box that more energy comes out than goes in, and it doesn't split atoms, okay? It does it through magnetism somehow. And look, if this is true, if some incredible technology, like some incredible way to produce energy is discovered or invented, or some incredible biotechnology or nanotechnology or whatever that solves big, huge problems. I mean, if someone masters the energy problem, for example, energy's got to be the biggest industry on the planet, I would assume. That would be the world's first trillionaire. You think Bill Gates and Warren Buffett are rich? No. The energy person is going to be the trillionaire, the first trillionaire, right? And so that would be massively deflationary initially. I mean, if energy got super cheap or free. Remember, I had Stephen Kotler on the show who wrote the book Abundance along with Peter Diamandis. That's a few episodes ago. And, one of the things they talk about in that book is how the prediction was that electricity would become so cheap that it wasn't even worth metering. It wasn't even worth keeping track. Just give it to everybody for free. Now, that didn't quite happen, but compared to the olden days, it really did happen. Because electricity is still pretty darn cheap, okay, even though it's gotten more expensive in recent years. So we don't know. The technology thing is a total wild card.
Right. And to that point, I guess you can say with technology, and that's another aspect of the whole inflation, because I guess my whole, circling back to my whole point was, is inflation in energy going to put deflationary pressure on house appreciation and commercial, building appreciation and rents? Is that what we're going to see going forward, And to that point, I guess you got to bring in supply. Now, I know you've seen household formation has been really pretty stagnant, since the Great Recession. But I guess that's a great hope, is there has been zero new builds or constructions really come to a halt. So you're going to have this real constraint on supply. And I think the what everybody's thinking going forward is going to happen is all of a sudden you're going to have all this household formation, and you're going to have lack of supply, and it's going to drive values up. I think that's kind of what everybody's betting on. But from a technology standpoint, people are starting to work from home now, and you got a lot of office buildings. You have a lot of once retail space, once warehouse space, and now those are, I think, are going to be existing units that can be converted into housing. You're starting to see it all over the inner city and urban areas already. What point, do we have enough supply out there that it's really going to not create that inflation that we're hoping for, and instead push the deflationary pressure? Is that another tool that's going to happen as the years go on.
Okay, so we've got numerous issues here we're talking about, okay, and we just can't cover them in a short conversation.
Right.
However, and maybe you want to call in again and we'll talk about some of those other issues, especially the financing one. I'd love to tackle that one as well, the money supply issue that you kind of alluded to earlier. But first of all, I have long said that, and I've been saying this for, 8+ years at least, okay, that housing is where it's at because Fortune 1000 companies are telling people to work out of the house. They can outsource the call centers to India. That's office space. They now outsource coding to India, Ukraine, Russia for software. That's office space. They can outsource manufacturing to China and other countries. That's industrial property. They can outsource shopping to the internet. And that is retail centers. So I completely agree that housing's where it's at. Now, what you said was really a conversation. You were about a year out of date on what you said about construction because construction is definitely ramping up. I am looking out my window right now. I live in the tallest all-residential building in the state of Arizona. And I'm looking out my window right now, and I see 2 big, giant cranes that are building high-rise buildings. And they're residential high-rise, by the way, not office. So I would not touch office space. I wouldn't touch retail. I wouldn't touch industrial. I'm all about housing. And the population has been increasing pretty dramatically in the past few years, although household formation has not, because Gen Y is the boomerang generation. They're living at home more. They're having a hard time. But ultimately, they will move out. Some will double up. Many people will have roommates for much longer than they used to. And that's all part of the standard of living declining. That's just all part of it. But ultimately, household formation is increasing. That is the trend. I mean, it has to. People can only live at home for so long. People eventually are going to move out, get married, have kids. Granted, they're doing it much later, but you know what they do in the process of waiting for all that to happen is they rent. They don't buy. So, but to answer your fundamental question of this phone call is that as energy prices rise, construction costs rise, the cost of creating all those raw materials that are the ingredients of a house, whether they be concrete, milling lumber, producing glass, steel, copper wire, petroleum products, all of that is energy. And as energy becomes more expensive, so does building. And if building gets too expensive, then they stop building unless people can afford to pay for it. So you have all these interplaying factors, but remember my concept that I've talked about on prior episodes about the 3 dimensions of real estate. And there are really more than 3, but I call it the 3 dimensions because it's a catchy title. So the rental market and the for sale market are most of the time countercyclical because when it's too expensive to buy, or there's a lack of financing, or the rates are too high on mortgages, or the building cost is too high, people are forced into the rental pool. When it's easy to buy, and so prices generally are suppressed to buy properties. But rents are counter to that. They're counter-cyclical. These are non-correlating indicators because the rents go up. As long as the population isn't declining, that is the one thing that really, really would derail my theory. And that's why states like your state and states like Michigan that generally are losing population, that are not business friendly, like California, I don't like those areas that much because you've got to have population growth for my whole theory to work. Like, if we didn't have population growth, I would have a completely different opinion of how this should all go, okay? And if we didn't have spending. Now, to get back on that energy thing just for a second, say this kid at his company, it's not his company, but he's one of the engineers that's like leading this project. Say this kid and his company solve the energy crisis problem. I've thought a lot about that since I met him and talked to him about what he's doing. And if the energy problem is solved at first, I think that would be very deflationary. Any great new technology like that would be deflationary. However, I wonder, and I don't know the answer, nobody really does, but I kind of speculate, if energy got super cheap, ultimately that would lead to an era of just unbelievable prosperity. And prosperity creates inflation. So initially, I think there'd be deflation. But after the prosperity started just coming into the global system and every human being was enriched dramatically. I mean, you think globalization has enriched 275 million people and pulled them out of poverty. Wow, you haven't seen anything yet. If energy was free or super cheap, I mean, it would pull everybody out of poverty. Everybody would be prosperous. It'd be amazing. And prosperity creates inflation. So it's all a cycle. So I don't know what would happen, but it's just kind of interesting.
I think if that were true, if energy were to become super cheap, I really think you'd see other things obviously become a lot more expensive. For example, rent, because again, the household budget, I really think you can make that a bigger piece of your expenses if you can decrease other areas of where most families spend.
Interesting topic and interesting question, Tony.
Hey, thank you.
Hey, my pleasure. I got to ask you, how did you find our podcast and how long have you been listening?
I've been listening probably about 3 years now. I found you on iTunes and I've been listening ever since.
Well, fantastic. Thank you for listening, and please spread the word and tell your friends. I appreciate you
calling
into the show.
Sure, I will. Yeah, I'd like to get in another conversation with you about cap rates, because I fundamentally disagree with you a little bit there, but that's a whole different topic we can talk about maybe some other time.
Gosh, you know what? That's probably a quick one. Let's talk about it. What about cap rates?
Well, to me, valuation of a property is ultimately determined by the kind of rent and the kind of income you can get from it.
Right.
So obviously in low cap rate areas such as New York City, you're going to see, 4% cap rates. Even in California at one time, they had 4% cap rates.
Oh, they had less than 4.
The whole idea is it's a better area, kind of like interest, on a CD. Obviously, if it's protected by the FDIC, you're going to get a lower rate because there's less risk. So low cap rates generally, I guess, can be interpreted as low risk. So people are going to pay a premium for that if you can get the kind of rent and the kind of income from it. So that means there's competition. That's what's driving price up. There's, I guess, into that is priced in, a revenue stream that's going to increase at a greater rate. So people are going to pay, a premium to kind of get into those kind of deals or to get into that kind of action.
Okay, well, so that's an interesting perspective, and I've never heard it expressed that way before. So you are right that in expensive areas with high land values like California and New York, cap rates are very, very low. I think those areas are terrible places to invest. The reason is cap rates are very low, meaning your cash-on-cash return is going to be low. A trophy property, like if you were to buy Trump Tower in the middle of Manhattan in New York City, the cap rate on that would be lousy. And you're right, competition does drive cap rates down.
But think about, in a way, where that competition is coming from, though. You're talking a highly educated demographic. You're talking great access to usually education, and people want in on those kinds of markets. You got great jobs and income and all those things. There's just so much that's driving that price up. People want in on that. In that area.
Wait a sec.
And those things have value, right? I mean, if you have a highly educated workforce, you have great companies paying good wages, and for the foreseeable future, they're going to be paying better wages, like San Francisco, for example. People want to get in those areas, and they're going to pay a premium to get on them. And if you lever it up 100%, then all of a sudden your cash-on-cash return looks kind of impressive.
Well, but it'll look more impressive in an area with a better cap rate. I mean, I don't think that theory holds water at all. Because first of all, those areas, the land and the prices of the property are too expensive. The people that are going into those properties are highly educated, you're right. But they're the institutional Wall Street style investors. Those are the ones accepting those lousy cap rates. And we've talked about this on the show many times. Number one, it's not their money. They will bend over backwards to squeeze 30 basis points out of a deal. I mean, it's incredible. They're like grabbing at the crumbs on the table compared to the kind of returns individual investors get. They can't manage a fragmented asset class like we can as individuals. So it doesn't work for them.
So many billions of dollars on the sideline chasing after these deals. I mean, if I've got $1 billion in a bank and I need to allocate that capital, where am I going? I'm not going into Tulsa, Oklahoma, with the 10 cap rate or 14 cap rate. I'm going into where I know that money is probably going to definitely have a better chance of increasing in value than it does. I guess it just all comes down to pricing. Yeah, you could take the higher cap rate, you're taking a little more of a risk, whereas the lower cap rate, you're taking a little lower risk as far as the fundamentals of what drives rent, what drives appreciation, and some of those things.
I disagree fervently, and here's why.
You're kidding me.
No, I'm not kidding you at all. Okay, listen, I lived my whole life in California. I'm abundantly familiar with trophy properties that my friends have purchased in places like La Jolla and Newport Beach and Irvine, and I think they're out of their mind. And the reason is because you're saying that you think that's a speculator's game. You're thinking that those properties will appreciate, and they have done that in the past. I'll give you that. But I don't think the future of those markets is very good at all. If we are really in for a bad slog in the economy, granted, it'll look like and it'll fool people into thinking there has been appreciation, but that appreciation will be in nominal, not real dollars, because there's been overall inflation. That boring property in Texas just churns out cash flow. And I'm a cash flow investor. If you or any of these other people are speculative investors, and listen, I've made lots of money speculating. Don't get me wrong. If I can buy a property, like I've purchased properties in Newport Coast before, Newport Coast, California, a very high-end area, and I've lived in them and sold them just a year or two later, and I got another $300,000, give or take, out of that property. I mean, that was a great deal, but could I depend on that? Did I know that was going to happen? Absolutely not. I got lucky, and I'd rather be lucky than good any day of the week.
Yeah,
sure,
but
I like cash
Texas,
flow.
You got tons of land, right? I mean, there's a lot of land as far as the eye can see. So you're always going to have the risk of supply. Now, you go into Metro Manhattan, it's all built up. There's no land. So you're going to, if you want in on and going there, and back to the demographics, for example, you have a younger generation who aren't even buying cars. I just read 50% of 18-year-olds don't even have a license. So they're willing to live urban in the city, and guess what? They're not going to have a car payment, so maybe they can pay that higher premium in rent going forward. They can allocate more of their money towards those. And I think people are looking at that whole, all those aspects, and they will pay a premium to go into those places where there's so much scarcity of supply, and future supply is kind of thwarted down, especially with, like you said, in California, you got building codes, things like that just make it very difficult to build and to bring in new supply. Whereas you go to Texas, I can go in there with a few buddies and a toolbox and probably start building some houses if I had a little cash on me.
No, you can't. You're wrong. Okay, and here's why: because we don't invest for land value. Our land is free. On the stuff we buy. Who cares about the land? It doesn't matter to me if there's a zillion acres of vacant land, because we're buying packaged commodities. I mean, you understand that. You opened this call with that question.
Oh, okay? Right. No. Yeah, that's what I'm saying. But when you have area for growth, if you have areas where you can build a lot more houses, or new builders can come in, these institutional investors can come in and start building up.
But that's
properties.
Not the point.
You're going to be able to increase the supply and drive down prices, where if you're in Manhattan, and that's the whole, I think, fundamental of the cap rate, because people are paying these premiums because they know, where else are you going to go? Who else is nobody's going to build in New Jersey, tomorrow. They're not going to be able to clear out 5 buildings and put in new apartments. It's going to take a lot of resources to do that. So people are willing to buy these turnkey, like you say, rent-ready houses, or in a big city like that.
You're not seeing the picture. Yes, an institutional builder can come in and build on all this vacant land, but so what? They have to pay for construction materials. That's the whole point of my philosophy, is you're investing in commodities, not land. I have said it many times before. I hate real estate. I don't even like real estate. You know what I like? I like commodities tied to 30-year fixed-rate debt. So if these institutional investors want to go in and act like idiots and buy 3 and 4 cap properties, let them do it all day long. You know why they don't care that much? First of all, it's not their money. It's someone else's money. Institutional investors like trophy properties. And I say to you, trophy properties are not where the money is at unless you have massive appreciation and speculative bubbles. And those do happen, and they have happened, but they are highly risky. We are very conservative here. We just want to be in a situation where we can buy properties that produce cash flow. What I'm into doing...
Jason, I totally agree. I totally agree with you. Don't get me wrong. I'm not saying I'm just trying to and I think you understand that the philosophy behind these low cap rates. Do the numbers make sense for you and I or a lot of investors out there? No. And should we be investing in those kinds of properties? I would say no. But, when you're talking people with hedge funds with billions of dollars and they need to employ and they need to engage that capital, that's where they go.
I know they do. Now, I agree.
They're not for you and I, but
I agree.
Let them go battle it out. Do those returns make sense? No, But I think for that kind of investor, that's how they get these cap rates going.
Well, yeah, the reason they get those cap rates down is, Warren Buffett really pretty much summed it up. I mean, we've quoted him so many times on the show making that quote from a few months ago when he said, if I could figure out how to buy a couple 100,000 or a couple million single-family homes and figure out how to manage them, I would do it. But they can't. They can't compete in our fragmented business. And that's why the opportunity is here for us and not for them. And by God, I hope they can never institutionalize it. They're trying. I mean, there are hedge funds buying up swaths of little single-family homes now. I don't think it's going to go that well for them. I think they're going to just get tired of the fragmentation and managing it. I mean, how many people do you know that rent a single-family home that send their rent check to some sort of hedge fund? Probably nobody, right? But you're going to start seeing a little bit of that. Mostly what they're doing is buying and flipping. And they're just dicing up large portfolios into smaller ones and selling them off and taking a profit there. But yeah, I mean, we don't compete with the institutional investors. I remember one of my friends sold a big apartment complex in Aliso Viejo, California, nice area and nice suburban area. And it's called the City Lights. And I think that complex went for like $90 million or some huge price. And I said, what was the cap rate? And forgive me because I can't remember, but it was low. Okay, the cap rate was like 4.5. It was terrible. I'm thinking I would never do that deal. But if they're buying properties with cash and they don't need cash flow because they're not going to get it, they can do that kind of premium stuff. It's just a different type of investor. The people listening to this show aren't those people, and I'm not one of those people. And I want cash flow. I want conservative stuff that just spins off cash. And if it appreciates, hey, that's the icing on the cake. This has been an interesting discussion. What do you think?
Yes. No, it was great. I love the engagement. Just to give you a little background, I bought 2 duplexes back when the market was almost on the peak. I bought one in 2005 and then one in 2008. So I got one at kind of the peak of the market and one at the down of the market. The good thing is I got them in foreclosure. They were REO properties. So I was able to buy them at a discount. They were in good areas with low competition as far as there weren't that many duplexes in the city that I bought them in. And they're in good schools, good suburbs.
But there's the thing. You're really giving the answer here. If you bought properties that made sense the day you bought them, one of my 10 commandments, right? Thou shalt not gamble. In other words, the cap rate was probably 8% or better, because that means the property will cash flow. If that cap rate is that good, who cares if the value goes down? You can weather almost any storm. If things get bad and the property depreciates in value, as long as you can maintain that income expense ratio, hey, you can just sit there and wait it out. And I saw that happen for over 20 years as I saw the Irvine Company, a big famous company owned by Donald Bren, one of the Forbes 400 richest people in America. They're in Southern California, and they're all over, but mostly in Southern California. And I've done lots of business with them over the years. I saw them in their residential, in their commercial properties. They will just wait the market out. They're a premium, high-priced, high-end developer, and manager of properties. And if you got a property that makes sense, and the reason it makes sense for them is they got the land so cheap so many years ago that their basis in it is so low that they can just wait. And if you're a big, fat institutional investor with loads of cash and you can wait, hey, the only way we as individual investors can afford to wait is by having a property that cash flows the day you buy it. That's all that works for them. But yeah, it's interesting background. What else did you want to say on that point, though?
Oh, no, I rehabbed them, and I was able to rehab. And I did it myself, so I was able to save a lot of money. So my upfront cost, my cash-on-cash return is much better because I was able to do the improvements myself. So, even when the market went down on the downside, that basically hedged my bet because I didn't pay top dollar for an older style house where I was able to buy at the bottom and put in new, fresh finishes. So I had a high-end place. So I was able to, that helps when I try to rent it out and things like that. It kind of gives me a competitive advantage. So, my goal is like yours, Jason. I just want to ride this thing out, and then when I'm older, just keep it cash flowing, keep it going, and being able to collect my rent. I would like to see appreciation on both sides. I want to see appreciation in rent, which I think we've all seen in the last couple of years.
Yeah.
But, I'd also like to see appreciation on the asset side as well. That would be, like you said, the icing on the cake. But even if it's not there, hey, so be it. As long as I can get appreciation as far as rents, I'm going to be a happy man.
Just remember one thing about that is that you're really unlikely, and we're all unlikely to see real appreciation. Most appreciation is just the result of inflation. It's an illusion. You don't really see it much in real dollars. Sometimes you do, but don't depend on that one at all. But if the commodities keep pace with inflation, but the debt is destroyed faster by inflation, and if you have leverage by, say, putting 20% down, you're really beating the inflation rate by a 5-to-1 ratio because you only paid 20% of the asset's cost. So if the asset keeps pace with inflation and it's only even, right? If inflation goes up at 3% and the property goes up at 3%, in real dollars, you've only treaded water. You've done nothing. However, if you leveraged it, all you do is you multiply that 3 by 5, and that gives you what? It gives you 15, and you've outdone inflation by a 5-to-1 ratio. So you've made money there, and at the same time, the debt, see, that's leverage, but then there's inflation-induced debt destruction. It's getting destroyed by the inflation, and hopefully your rents are going up. That, my friend, is a beautiful equation.
Right.
All right, good. Well, hey, thank you so much, Tony, for calling in, and I appreciate the heated debate. I love being challenged on my ideas, okay? So, listeners, heed that call, okay? If you've got a question out there or you want to challenge me on an idea, it's great. It makes me think about it. It's kind of like exercise. You got to exercise your brain and your ideas. So, I totally appreciate it. And call in again, okay?
Sure. Thank you, Jason.
All right, my friend. Happy investing.
All right. Take care.
Now's your opportunity to get the Financial Freedom Report. The Financial Freedom Report provides financial self-defense in uncertain times, and it's your source for innovative, forward-thinking investment property strategies and advice. Get your newsletter subscription today. You get a digital download and even more. The price only $197. Go to jasonhartman.com to get yours today.
Just a reminder, you're listening to Flashback Friday. Our new episodes are published every Monday and every Wednesday. It's my pleasure to welcome Larry Muck to the show. He is the Executive Director of the American Association of Private Lenders. And in the real estate industry and the private lending industry, it's a very fragmented business, as we all know, and I've talked about many times on the show. And there are some organizations cropping up here and there to try and organize things a little bit more, and this is one of them. Larry, welcome. How are you?
Thank you very much. I'm great today.
Good. Where are you located?
Our headquarters are in Kansas City. We moved the headquarters of the business from Raleigh, North Carolina to Kansas City in August.
Fantastic. And tell us about, you use the acronym AAPL, the history of it just quickly, and what the vision and the role it fills.
Yeah, AAPL was formed in about 4 years ago by 4 guys that were involved in the industry from various aspects, an attorney, a CPA, portfolio examiner and a private lender. And their idea was to help raise the standards within the industry and to develop a brand really that could be used by private lenders to say, hey, we're vetted, we're good lenders, we belong to the association, and therefore we're fairly trustworthy. We all know that in this space there are people that are predatory lenders, and the association was formed really to begin to emphasize the educational aspects of private lending, to bring better knowledge and to raise standards in the industry. We got involved in the association this summer, made a capital investment to bring it to a full-time staff, to bring full-time staff positions to it, and to really work on building the value proposition of the association. So we are in the midst of working hard to identify private lenders and to begin to build that network of people across the U.S. that really are both vendors to that space and investors in it, and then the private lenders themselves.
So the members would be private lenders, certainly not borrowers. They're not going to join an association. But the private lenders would be the members, and then I assume different people that provide different tools to private lenders and so forth. What are the membership fees?
Well, we've restructured our membership fees. We have $400 minimum membership, $800 for a premium membership, and $1,600 for a corporate membership. We continue to review that membership structure because, frankly, our goal is to get to the point where we have over 500 members and then beyond that over the next year or so. We've got a long way to go. We're at about 120 to 130 members now, but we are working at it full time.
Right. So it's a pretty small association, just 120, 130 members. But what do you estimate? I mean, and this is probably impossible to really know, but what do you estimate as the number of private lenders out there in the country? I mean, are there thousands of them? Are there millions? Oh, I know there's thousands. Are there hundreds of thousands? Are there millions of them? Just anybody who makes a loan. And, I assume we're always talking about secured by real estate, right, in this conversation?
Not necessarily. I mean, we principally represent, the lenders in our association are principally commercial lenders. And I say that we don't have many mortgage lenders that are doing owner-occupied. The laws related to that are fairly onerous.
Right. It's investor property that they're financing because they don't have all the legalities of these homeowner-oriented RESPA laws and the predatory lending laws. In other words, when you lend to an investor...
Dodd-Frank and,
Right. When you lend to an investor, the law makes something of an assumption that the investor as a borrower knows what they're doing and can protect themselves. Would that be fair to say?
Exactly.
Yeah. Right. Okay.
Yeah, exactly right. But we do have members that are doing larger deals, the commercial loans, building loans, office buildings, that sort of thing. But the bread and butter is that lender that's looking into the residential space. Again, we hope to expand the definition and draw in other parties to the association.
Let's talk about why someone would want to be a private lender. I mean, when you can earn a whopping 0.2% in the bank, why would someone want to fool around with this? I'm, of course, being sarcastic.
Well, of course, yeah. It's, the private lenders do get a much better return than you can get almost anywhere. And as we look at the future, where are people going to put their money? Are you going to bet on the stock market for the next 4 or 5 years with the debt bubble that we've been building? Are you going to be in the bond market? It's really hard to see any kind of positive returns in those asset classes. There have not been for 13 years.
And don't forget to mention though that on those asset classes you have no control. With being a private lender, you're a direct investor. I mean, you exert direct control over the investment, the choices, and, it's not hard to learn. I mean, this is not a complicated thing. You don't have to know how to evaluate a business, which is an incredibly complex creature with so many moving parts, and that's what you do as a stock investor, really. And then, of course, bonds have massive inflation risk. I mean, I wouldn't touch bonds in this world nowadays. It's just too
No,
risky. But hard money loans or private loans can be short term, and I think they offer some great opportunities. Again, as I mentioned before we started recording, they're my second favorite investment. My first being actually owning the property itself, but the thing I love about the lending is it's just very streamlined and simple.
Right, and your listeners know this as a fact, but when we got up to 70% home ownership in this country, we knew that wasn't sustainable. And now, the way things are going, the trends are that we are becoming a much greater rental society than we ever have been in the past. And so home ownership, who knows where that'll settle out, but there are tons of opportunities for people to get into this business. And frankly, there are more tools available now to support investors, lenders, across the country. That
talk about some of those tools, if you would. What are they?
Well, gosh, I've met a lot of people over the past couple of months as I've gotten very involved in this industry, and as I mentioned to you, I'm a 30-year lender. I was in banking for that period of time before I came to the association. But we have. One of the ones I was mentioning to you was a real property management franchise system that is really putting tools in the hands of people. They have GPS tracking tools for your maintenance guys so that you know exactly how long they were at an address. And for those that are managing properties, for remote investors or out-of-market investors, they offer an opportunity for you to prove what it is that you're doing with your investment.
And that's great on the management side, but anything on the lending side to make lenders safer, to reduce risk, property evaluation tools. Of course, we're all familiar with the stuff that's available just kind of publicly. Everybody knows about Zillow nowadays and Trulia and things like that. There are some great research opportunities on the web, of course, better than we've ever had in the past. But are there some specific tracking tools or evaluation tools that your association is seeing and recommending?
We're working with a company by the name of RentRange.com.
Sure, I'm familiar with them.
In that space, they really own that space from providing critical data to property managers in terms of what the rents are. And they're particularly useful when you're looking at buying properties. We're also working with another company that is rolling out a tool at our annual conference, and they provide a nationally validated risk profile for investment properties. As a matter of fact, these guys are private lenders themselves, and we're using this tool to evaluate risk, and they have now really developed that tool to be rolled out to other investors and lenders that want to use it to evaluate the situations that they're getting into. Our lenders tend to be local market people, although some are starting to branch out into other markets, and as they do that, they need some of these evaluation tools to be able to to ferret out the risk.
Sure, absolutely, absolutely. The problem with being a local market investor is you may not live in the right place, and even if you do, you won't be diversified. So that's the challenge.
Exactly, and so, and as we've talked, more and more people are beginning to marry up in this industry. You have turnkey providers that are soliciting investors, becoming fund managers themselves. Also, you have an expansion of people that are wanting to get into this lending space. And our association really, for people that are looking at getting into lending, we can network you with guys that have been doing it for a long, long time and are professionals at it. And that's really one of the major benefits of joining the association, is to network with professionals from across the country that not only can help you from an educational standpoint, but will also enable you to push deals to each other in different parts of the country.
So you have an event coming up in Las Vegas. When is that? What is the price? And how many people do you expect?
Well, the event is at Caesars Palace in Las Vegas from November 4th through November 6th, and you can read all about the event at www.aaplexpo.com, and that's our event website. We're expecting in the neighborhood of 150 to 175 people. We have very high quality vendors to the private lending industry that are going to be there, as well as mortgage brokers, private lenders. We have a number of attorneys coming, and who doesn't want to talk to an attorney and get get advice from them that they don't really have to pay for at a conference. So we have a wide variety of people. I want to make clear that at this event, this is not a pitch fest. This is an educational event, and it's not about selling things. It's not about selling at the back of the room. It's truly an educational network event. We have a keynote speaker by the name of Mark Calabria, and most people probably don't know him, but he is with the Cato Institute and is Director of Banking Regulation Studies. He's worked on the Senate Banking Committee. He was a staffer on the National Association of Realtors and the National Association of Home Builders. And he will be at our reception on Sunday evening and then giving the keynote address on Monday. And I would urge anybody that would want to come to the conference to get an absentee ballot, because we are going through Election Day on Tuesday.
Good stuff. Well, hey, thank you so much. And I believe you gave out the website. Do you want to just quickly mention the website again?
Sure. It's www.aapl.expo.com.
Fantastic. Well, Larry, thank you for joining us today.
Okay, thanks.
What's great about the shows you'll find on jasonhartman.com is that if you want to learn about investing in and managing income properties for college students, there's a show for that. If you want to learn how to get noticed online and in social media, there's a show for that. If you want to know how to save on life's largest expense, there's a show for that. And if you'd like to know about America's crime of the century, there's even a show for that. Yep. There's a show for just about anything, only from jasonhartman.com, or type in Jason Hartman in the iTunes Store.
This show is produced by the Hartman Media Company, all rights reserved. For distribution or publication rights and media interviews, please visit www.hartmanmedia.com or email media@hartmanmedia.com. Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, or business professional for individualized advice. Opinions of guests are their own, and the host is acting on behalf of Platinum Properties Investor Network, Inc. exclusively.